Hello, this is Rob and Mike from the McClellan Financial Group of Asante Capital Management, and this is ThinkSmart with TMFG. Mike, today is Friday, February the 28th, and as we sit here doing our podcast, the world stock market is down close to 15% from where it was a few short weeks ago.
Basically a week ago.
Almost a week ago. So what's going on here?
Well, you have a combination of two things. Number one, we were in a very high stock market previously. 2019 was a very strong year. And the second thing that we ran into is we have this coronavirus. At the end of 2019 had started up, but it seems to be spreading and right across the world now, and it worries people.
I guess the interesting thing is, why we always say you can't predict the markets is because you can't predict the future. When this coronavirus first came out, the expectation was that it would be able to be controlled, in all likelihood, within China.
Yep.
But as time went on, this thing appears to have spread. I think it's now in 50 countries, and it's impacted many things in the world. What are some of those things that have been impacted that have caused the market to drop, though?
Well, much like the disease itself has moved outside of China, the effects of the disease have also moved outside of China. And this is when you get into things like supply chain disruption. And what that means is if you have companies that are reliant on Chinese parts, all of a sudden the factories in China have started to close down. Now they've used up the inventory of parts, and whatever they're producing, they can no longer produce because they need these parts from China. It is very difficult for other places in the world to retool their factories to compete with these parts that are made in China. We were talking before about a door handle on a car, maybe produced in China for a company that's making cars in Korea. So all of a sudden they run out of door handles, and now what are they going to do?
It's not like they can sub in another door handle. Whereas think if you go out to a restaurant and they happen to have roast beef as the special that evening, and there's 4 people in your party, and they go, sorry, we only have 1 roast beef dinner left.
Yep.
Well, you just sub in a pork dinner or a chicken dinner. It's pretty easy. But if you're making cars, you can't just sub in someone else's. You can't put a Volvo door handle in a Mercedes. It's just not going to work.
And we got to remember, this is a temporary thing too, right? So if we take this out 6 months to a year from now, those Chinese factories will be back in full production again. So no one's going to spend the money to retool their factory to produce something for 6 months that the Chinese are going to beat you up with afterwards, right?
Already we're hearing that, where we were in a complete shutdown for a while, almost a third of the Chinese factories are back in business. So things are starting to happen again. So we've seen this market correction, and what happens with the market correction is it's forecasting something. What's it forecasting?
Well, the one thing the market does tend to forecast, not all the times, but some of the time, is when we head into a recession. The market is basically the leading indicator of a recession. Now, what I need to remind everyone, a recession is 2 negative quarters of growth of GDP.
So if the GDP was down 2% for one 3-month period and 1% for another 3-month period, it's down 3% from where it was, that's considered a recession.
Yes. The one thing that people get very mixed up with it is recessions and bear markets. They think they all happen at the same time. In reality, they don't. The bear market happens first, then the recession comes. Markets are not actually that bad during recessionary periods. It's a recovery period for them.
What I think is interesting about this one, like every correction, is no one knows when it starts and when it ends. So what have we learned over the years about, how to negotiate your way around these things? Should we be moving to cash? Would you take your portfolio and move it to cash?
No, absolutely not.
Why wouldn't you?
Well, we go through with clients something called a lifeboat drill. And you've done it, I've done it. Most people listening to this podcast now have probably been through it with ourselves. And it looks at past events that have happened on the marketplace that really shook the marketplace. and we look at back in the 72, 73, back in Black Monday in 87, in 1990, the Gulf War. We look at the 2001, 2002 tech correction. We look at 2008, 2009, the failure of all the financial institutions. So we've learned from all this stuff, right? And what have we learned?
We've learned that, number one, the market's going to do what it's going to do. It's going to fall down 10, 20, 30, maybe like 2008, 50%. No one knows. No one knows. But what we do know is even when that happens, 5 years out, the market climbs and well surpasses where it was at its previous peak. And 10 years out, most of the time it doubles where it was at in its previous peak. That's how markets work.
If you have a diversified, balanced portfolio, you will always recover. That goes without saying. And all that we're trying to decide is how much time it takes.
I always think of recessions as interesting. You know, everyone dwells on the GDP is down 2% or 3%, but it's still going at 97 or 98%. You know, I get up some days and if I'm going at 97%, I'm pretty happy. Yep. I wish I could go at 105% every day. I get some days I'm at 80%. We all know that. And we're okay with that.
I remember back in 2008, 2009, we look out the window and everyone's still driving up and down Yonge Street. And we went out, I remember to talk about things. We go to Tim Hortons and we still got in line in Tim Hortons. And we still have to wait, 10 minutes behind 20 teenagers, and so there is still money out there. People are still spending. People still need to eat. People still need to drive cars. People still need to brush their teeth in the morning. And as long as all those needs are still there, those companies that provide those needs are still going to prosper.
I want to go back to this concept of getting out. I always think it's an interesting one. So let's go back 2 weeks ago when the news was better and markets were up and everyone was okay. And now the market's down 15% and the news is worse. And now everyone's thinking I should get out. So imagine if you did get out today at 15%, you locked in those losses, you cut a check to Justin Trudeau and the government for taxes for any of your open account gains. And now your next move is what?
Well, after that, you got to decide when to get back in.
So I'm going to get back in when the market's down further. So what's wrong with that thinking? It sounds really easy to do. I'm going to wait till things are worse.
What it assumes is someone's going to tell you the bottom of the market. Someone's going to pat you on the shoulder to say, hey, listen, we're at the bottom. It's time to put all your money back in it right now. I guarantee it'll be okay at this time. Is that the news you actually receive? Is that the news we got in 2009?
So if the market's down 15 and it's suddenly down 30, what's happened? What's the difference between 15 and 30? The news is what?
The news is worse.
The news is worse. You want to get out at 15. Do you think you're going to have the ability to get in at 30? No one ever does. That's the part that's hard. You can get timing right once. You can't get it right twice.
The other thing we always forget is for every person that gets out, for every seller, on the other end of the trade is a
buyer. Someone's buying your mutual fund. Someone's buying the stocks in your mutual fund.
And you're getting out at a low because things have went down, and the person that's buying is also buying at a low. We know this whole idea of buy low, sell high. Yet when we come to times like this, everyone throws that out the window.
So say I own shares of Royal Bank. If I'm selling my Royal Bank shares today, am I selling them am I just giving them back to Royal Bank and saying, here?
No, there's another person on the end of that transaction who thinks Royal Bank is a good deal.
At the price I'm giving it to them at.
Remember back in 2009, I think it was Citibank. Went from like $100 down to $2. So someone actually stepped in at $2 and bought that off the person that was selling it. And now it's worth, I forget, it was worth $30 or $40. But someone made that transaction in there to buy that at that low price and take advantage of the markets.
I've been doing this for a long time. The one thing I've learned about market corrections and bear markets is that everyone is different. Everyone feels it's different this time. And they're all scary in their own in the way they operate, they're all scary. Let's not deny that. But what I have learned is just let it go. Don't worry about it. Don't stress over it. You've got a portfolio that's extremely diversified to handle this stuff. Some clients have a more conservative portfolio. Some clients have a less conservative portfolio. It doesn't matter. The portfolio is the right one for you.
This was all taken into consideration when we're designing everything.
So the lesson for the day is, yes, we're going through a correction. We don't know how long it'll last. We don't know how deep it will be. We don't know when it will end. But we do know the best way of getting through it is doing absolutely nothing. This is Rob and Mike with the McClellan Financial Group and ThinkSmart with TMFG.
You have been listening to the McClellan Financial Group of Asante Capital Management Limited. Asante Capital Management Limited is a member of the Canadian Investor Protection Fund, an investment industry regulatory organization of Canada. Insurance products and services are provided through Asante Estate and Insurance Services Incorporated. This material is provided for general information and is subject to change without notice. Every effort has been made to compile this material from reliable sources, however, no warranty can be made as to its accuracy or completeness. Before acting on any of the above, please make sure to see a professional advisor for individual financial advice based on your personal circumstances.